Alex, let's start our lecture on investment analysis and asset valuation. And today we'll start the second part of our course as asset valuation. Can you hear me and see my presentation? All's good? You can answer in chat or you can use the microphone. Yes, thanks a lot. Good, let's. Today we're starting the second part of our course, our business evaluation or asset evaluation. And as we started our asset evaluation in previous school year, in our previous course, so why in this part of our investment analysis, I decided to concentrate on the theoretical frameworks of asset evaluation, or we'll start the next level of asset evaluation. We studied the main conceptions of company evaluation and asset valuation. As in previous year, we studied our asset valuation in the form of our building valuation and our intangible asset valuation, and we started the main models for companies valuation. We trained in finding the company value using our standard model of company valuation. So why in this year we'll concentrate on the peculiarities in business valuation and asset valuation. We'll form the foundation of our business evaluation. And during our seminars, we'll find the solution or we'll solve different theoretical questions and different cases of business evaluation and asset evaluation. We'll exclude our practical model as we studied this model in previous year. So why in this year we'll find the solution for different cases in our business evaluation, and certainly it will be the professional level of business and asset evaluation. And the main topic for our current lecture, it will be the main principles, the basic of business evaluation, and we'll sum up our company evaluation methods. We'll make knowledge on the new methods proposed by international standards of company evaluation, and certainly we'll form the foundation for our asset evaluation and business evaluation. And then we'll form the main principles, we'll form the main models for different approaches in our company evaluation. And as the start point, I'd like to remember that in our evaluation, there are two view of points or point of view. What asset will we value? On the one hand, we can value our company, but on the other hand, our company is divided by different business units. And it's question. It's a question, certainly, what should we value? What should we find the value for our company or for our business? On the one hand, our company includes different businesses, different business units, and so why in finding the value of our company, we have to find the value of all assets of our company. We have to find the value of our fixed assets, for example, of our short-term assets or our current assets. We have to exclude the influence of our debt in different reactions in different forms, such as long-term debt and short-term debt, and we'll find the value of equity. In this point of view, our company is presented by the sum of different businesses of different business units. But on the other hand, our business includes different companies. And for example, if we are well, I don't know, food processing business or reconstruction business or pharmaceutical business, we have to find the value of all participants of this business, of all companies included in this business. And so why we can notice our business evaluation is a more common category, more global category comparing with our company valuation. But to tell the truth, first of all, to simple our task, to make the purpose of company valuation more simple, it's decided to make the equivalence between company value and business value. So why in this context, when we find the company value and the value which our company was concentrated, was attracted. And so why certainly our business evaluation includes as our company valuation as a common, as a global category, and the valuation of different assets, our property of the company. And let's start on the philosophical basis for our valuation, for the foundation of our valuation. And as we started in our previous course, the main purpose, the main goal for our company valuation is the finding of equity value. And equity is the presentation of our business, is the presentation of our company. And many investors believe that the pursuit of true value based upon financial fundamentals and is a fruitless one in markets where prices often seem to have little to do with value. It's a true statement as our market in all cases reacts to different changes of external and internal conditions. And sometimes our market value does not reflect correctly the main resources of our company and the main prospects of our company, the future deliverance of our company, as we can notice. And so why it's quite necessary to compare the intrinsic value of our business or the correct value received by using the per comparison analysis or received by using our income approach or perhaps using our cost approach when we have to find the market value of all assets, especially tangible assets of our business, and then by excluding our debt, we'll find the value of our equity. And we have to compare this intrinsic, this potential value of our business with the market value, and make the conclusion about our company is overvalued or undervalued. Sometimes our investors pay attention to the market value as the most correct value of our business, which reflects the investors' expectations. And in this case, certainly finding the correct value of our business, finding the true value of our business helps us to make the solution about our future financial research and our future financial actions to buy the shares of this company or perhaps to sell the securities of this business. And asset prices cannot be justified by merely using the bigger fool theory. And to tell the truth, all categories in our corporate finance are connected. And our company evaluation, our asset evaluation has a great part of the same characteristics or the similar characteristics with our different securities. And as we approved in our investment analysis, our value and our valuation of investment project and finding the correct parameters of our investment project has the similar characteristics with finding the main categories with our security bonds. The same, our discounted payback period, our internal rate of return, and certainly our net present value, so for the projects or for our bonds. And when we are concentrating on our company valuation, we can meet two attitudes to our company valuation. And broadly speaking, there are two methods for valuing our equity capital, such as direct method and our indirect method. If we propose our indirect method, it means we are finding the total value of our business, perhaps the intrinsic value of our business, which includes not only our equity, but certainly our debt. But if you are realizing your business, if you are proposing the rights for your business, if you are realizing the deal of merger and acquisitions, certainly for buyer, the total value of your business, the total intrinsic value of your business will not be interesting. As in this case, our buyer must return our debt, and so why only the equity will be vested. And when we realize the indirect method in our company valuation, we have to find the value of our total company or the value of our total invested capital, such as sum of our long-term debt, short-term debt, and certainly our third part of the balance sheet, our equity and reserves. But then we have to exclude the market value of our debt. And in this context, the market value of our debt will be presented as not only the body of our debt, as not only the main amount, the main sum of our debt, but certainly our investment payments. And it's the presentation, it's the description of our indirect method in company value. But on the other hand, we have to use our direct method. And in our direct method, we'll start on finding the value of our capital. And certainly there are different presentations of finding the value of our equity in form based on our free cash flows for equity or in form of finding economic value added. In our previous lecture, we studied, and our previous seminar, we studied a real option valuation. And we named our real option valuation as an instrument how to increase the company value, how to use the flexibility of our internal decisions based on the external uncertainty, and how to boost the company value using different managerial decisions in our business. And certainly it's a very important instrument of boosting the value of our equity, of using our direct method, certainly our direct method. And in the direct method, obviously we value equity capital directly. And later we'll study the income method in the context of our company value. We'll study our per comparison method. And certainly we'll form our parameters, our details in income approach based on our direct method. For example, in our per comparison approach, we'll use different multiples. And we'll divide our multiples to global multiples and for defined multiples. Our defined or only reflected equity multiples will include only our capitalization of the company, only the market value of our company, and we'll find the interconnection between our capitalization and different financial results of our business, such as net income or such as dividends or such as our free cash flows for equity. But on the other hand, we'll use our enterprise value as the reflection of our indirect method, and in the context of our enterprise value, we'll find certainly the same multiples, but then in finding the real company value, we'll exclude the influence of our net debt. In other words, the debt without the influence of our cash flow, so with reduction of our cash and cash equivalents. And in the indirect method, we first value the firm as a whole, what we call enterprise or firm value in this context, and then subtract the value of net debt, or in other words, our debt minus cash and cash equivalents. And on the one hand, certainly our enterprise value will be higher comparing with our equity value, comparing with our direct method. But on the other hand, don't forget about the main resources of financing our business. Don't forget about the main instruments of attracting the capital. And let's remember that our external instruments of company financing certainly can maximize the company value, but our company does not own this instrument, does not possess these instruments, and so why certainly to reflect the correct intrinsic internal value of our business or equity value of our business, we have to exclude our external resources such as our debt. And certainly, if we sum up, for example, the main approaches in company's valuation, in our income approach, we'll divide our company value based on our free cash flows for firm and free cash flows for equity on the one hand. And certainly, if we use the algorithm, the mechanism of our free cash flows for firm, for example, in the last step, on the last statement, will exclude the value of our debt. If we remember our per comparison approach, we'll exclude the same after using all our premiums and discounts. We'll exclude our debt and we'll receive our equity value. If we are using the sum of the parts method or our cost approach, the same. In our net asset value, we'll concentrate on our market value of all our assets. We revalue all our assets to the market value. We'll exclude the no traded assets, no liquid assets or liquid assets. And then we'll revalue the meaning of our debt. And in this context, it means, first of all, finding the turnover ratio for our trade payables and discounting our trade payables based on an average period of returning, and we'll add our interest payments for our credit, and then our corrected assets or assets not far from the market value exclude our market value of our debt, will receive the value of our equity. In the context of liquidation value, the last method, including in our cost approach, in the context of our liquidation value, the same, will revalue only the assets which can be traded, which can be proposed in the market. And after finding the market value of all liquid assets, will exclude the influence of our debt. And it's the main characteristics of our direct and indirect method in company valuation and asset valuation. And now let's try to answer the question who are interested in business valuation. And as you know, there are different kinds of value for our business. There are different sorts of value for our business. And so I certainly finding the value is directly connected with the stakeholders of this value. In other words, for our investors, perhaps, we'll find the total enterprise value of our company. For our shareholders or stockholders of our business, certainly we'll find the fair value of our business or the equity value of our business. For our management, we'll find the minimum, perhaps the minimum or the minimized value for our equity as the object to be maximized, as the object to increase the value in context of our value-based management. And for insurance companies, certainly will transform our value, first of all, to the sum of all our assets. Let's stop on all of these participants in our business valuation, and let's find the main purposes, the main goals for all of these stakeholders of our business. As I said earlier, if we are finding the value for our management, certainly our management is interested in finding the clarified, the defined value of the equity to maximize this value and to find the tools of increasing the value of the equity as the base, as the foundation of our business. And certainly for our management, perhaps the most appropriate approach to be used or the most suitable approach will be our free cash flows for equity approach and our economic value added approach, our EVA approach. Perhaps residual income as the difference for our economic value added. Our managers will be interested in finding the return on all investments and in finding the spread between return on our investments and the cost of capital. And in situation of receiving the positive spread between return on invested capital minus our WACC, certainly the positive spread reflects the correct behavior of our managers, the correct actions of our managers. And so why our managers, perhaps they will be interested in finding the financial results of our business based on our economic value added, based on our free cash flows for equity method or DCF approaches, as you know, and perhaps our managers will be interested in finding the per comparison approach in finding the value of our company comparing with another market participants, and to find the potential, the prospects of our business. As about our creditors certainly will concentrate on finding the value of our business based on based on internal resources of our business, for example, based on free cash flows for equity or free cash flows for firm. And certainly it will be our DCF approach. Our creditors, they won't be attracted in comparative approach or comparison method. As for our creditors, the comparative analysis with another market participants won't be interesting. They are interested in finding the real value of assets of our company or the real value of perspectives of our business, of features of our business. As about our shareholders, certainly our shareholders will use the DCF approach for our business as the long-term approach in company valuation and as the reflection of all perspectives of our business, such as growth in our sales and in other categories. As about our state certainly, as our state receives tax payments, our state will be interested in asset valuation, in finding the company value as the sum of all assets using, first of all, our cost approach. Or perhaps in the situation of bankruptcy, in situation of financial falling, our state will be interested in finding the liquidation value of our business to realize the company under the bankruptcy, under the conditions of financial default. As about insurance companies, certainly our insurance companies will ignore all our free cash flows, will ignore all our comparative approach, will ignore all our comparative analysis with another companies, and insurance companies will be attracted in asset valuation, as they propose different schemes of our asset valuation, such as property insurance schemes, or they propose the schemes, the programs to insure the property, to insure the assets, to insure the interest, and so on. So why? As you can notice, for all our participants, the methods of valuation, the schemes of valuation, the approach of valuation will be different according to their expectations for our business, first of all. And let's sum up, let's summarize the cases in which we have to find the company value, in which we have to find the true value of our business. And certainly there are different cases for finding the company value. For example, for open companies, we have to find the true value, and our true value will be necessary, first of all, to comparative analysis with the stock market position, with the stock market attitude for our business. And perhaps our securities market is not developed, and the reaction of our financial market demands a high period of attraction. And so why certainly it's quite necessary to find the fair value of our business, to compare with market value, or to find the correct market value of our business. Perhaps our company is formally open, but our company is not listed in the stock exchange market according different requirements. And certainly in this situation, it's quite necessary to find the fair value of our business. And perhaps our company is an open joint stock company, but our shares are not liquid, or our market is not interested in our company shares. And so why the reaction of our market will ignore all positive or negative changes in our company. And certainly in this case, we have to find a fair value of our business. And in the situation of high volatility of our securities market, of our financial market, in this situation, certainly it's quite necessary to find a fair value of our company. And the next part about our company value, to tell the truth, I took this slide from Damodar Ansar. The main myth of our evaluation. And first of all, the first myth, evaluation is an objective study of reliable cost. And as we approved in our previous course, in our previous lectures, all evaluations are subjective. And certainly it depends on the amount of requirements, on the amount of exceptions we add in our company value. It depends on our analogs, which you will find in our company value. It depends on our exceptions in growth for our business, for our company. And certainly the main purpose for us is to convince, to approve our requirements for the business, to approve our exceptions to the business. The second myth, qualitative assessment determines the exact value of a business. And as you know, there is no exact evolution of our business, of our company. And if we use different approaches in our company value, we'll receive different results. We'll receive different final value of our business. And the highest value we'll receive in using our DCF approach in company value, if we add the parameter of our growth in company value. The minimum value of our business will be achieved, will be received in using our cost approach, and more correctly, our liquidation value. In our liquidation value, we'll use the only value of liquid assets of the company, and we'll ignore different intangible assets of our business, such as goodwill, for example, such as reputation, such as possibilities of our company, such as sustainability of our business. And the reward for the evolution of the topic is higher, the less accurate the estimate. And as we approved, and as you can notice, if you are finding different values of business, only simple models will be useful in our company's valuation. And when we prepare our valuation report, or our report on company valuation, we'll use a standard, simple, and our understandable methods in company valuation. Simple models are better than complex ones in our company valuation. And now let's stop on type of estimated value and the main purposes of our valuation. Let's concentrate and let's explain our purposes of evaluation. And let's form the definition of our company valuation. First of all, if we propose the definition of our company value, value is a monetary equivalent which the buyer is ready to exchange for the right to possess, dispose of an object. The same definition we can propose for our defined asset valuation. Value of asset is a monetary equivalent which the buyer is ready to exchange for the right to own, dispose of an asset in this situation. And certainly in finding the asset valuation or in finding the company value, we have to find on the one hand the minimum value, on the other hand the maximum value. In other words, it will be the maximum value for our buyer or the maximum value on which our buyer is ready, and the minimum value for our purchaser, for our seller in the situation, and the minimum value for which our seller is ready to sell the business. The term cost is ambitious and should not be used without an appropriate definition. And certainly it depends on circumstances. If you compare your business with another market participants and when you receive the value based on comparative approach, it will be the market reaction to this industry, to this field of activities, to this field of operations. If we use our DCF approach, if we use our income approach, certainly in this context we'll receive the value based on our growth, first of all, based on our potential of the company, our perspectives of the company, and our possibilities of the business, possibilities of the company. And perhaps it will be the maximum value for our company. And as we are finding the value of our business, such as the sum of the parts method, in this context, certainly we'll receive on the one hand, the minimum value of our business, on the other hand, a real value of all assets of our business. We'll ignore cash flows of our business and we'll replace cash flows of our business by the assets, which is this category which is under the pressure in property of our company. And so while we have to prove, we have all variants to prove the company has several different values for the same date, and it depends on internal and external circumstances for our business. The main resource of forming the company value is our financial statement analysis, and based on our financial statement analysis, based on our different documents to be used in company value, we have all opportunities to find the company value. What does it mean? There are two main forms which we have to use in practice in finding our company value. First of all, for our cost approach and partly for our comparison method, we'll use our balance sheet. But certainly, especially in our cost approach, especially in our net asset value, we'll use our financial statement analysis, we'll use our balance sheet analysis. When we revalue all our lines, when we revalue all our positions from the balance sheet. Could you explain me, as we started the main principles of our cost approach, how could we use our balance sheet in our liquidation value and in our net asset value? Certainly, you can use the microphone or you can use the chart, for example. How could we use the analysis of our balance sheet in net asset value and in liquidation value? Could you explain me the mechanism of using our balance sheet as the resource for our cost approach, as the resource for our net asset value, liquidation value, and partly our comparative approach? You can use the microphone or you can use the chat, it depends on you. Why should we name our balance sheet as the resource of realizing our cost approach and partly our per comparative method? Could you explain me? Do determine asset price exactly based on our balance sheet, in our, first of all, in our cost approach. We'll have the opportunity to determine asset price. And in which context could we determine asset price using our balance sheet? Could you continue your proposal? Could you continue your thought? Or could you explain to us? To determine asset price, certainly I agree with you, but how in liquidation situation, in finding the liquidation value, exactly, in finding the liquidation value, we'll take the list of, Maria, just a second, thanks a lot for your answer. In our liquidation value, we'll take the range, the list of our assets, only our liquid asset, and then we'll find the market value of these liquid assets, and then we'll exclude our debt and receive our real value. Exactly, real value. Certainly, I can agree with you in liquidation situation. And continuing your proposal, for example, in our net asset value, the same, we'll use the results of our balance sheet to find the market value of these assets in this context. If we are using the comparative approach of the comparison method, a wide range of our multiples can be formed, for example, based on our fixed assets. For example, it will be enterprise value divided by fixed assets, or enterprise value divided by total assets of the company. It's global, it's a common multiple for our calculations, exactly. And as residual value exactly, we can use our balance sheet as the resource of data, as the resource of information. Exactly. And certainly, let's return for our slide. On the one hand, certainly it will be our balance sheet. But the most value, the most value for our company valuation, for this pursuit of finding the company value, is concentrated for our profit and losses results, our P&L statement, or our research, our report on financial situation in our company. And based on our P&L results, based on our financial statement analysis, financial results analysis, certainly will form our, first of all, on our DCF approach, our income approach, and the main part of our multiples multiples in per comparison approach will be formed based on our financial results, such as enterprise value divided by sales, such as capitalization divided by net income, such as, for example, our enterprise value divided by our gross profit, and another coefficients and another results. Certainly, P&L will be very useful in company valuation and finding the company value. And our DCF approach is totally based on our P&L. On the one hand, you'll find the growth of your sales. Secondly, you'll find the weight of all your expenditures in sales, and using the sum of the parts method or the weight in our sales approach, we'll find the company value. And let's sum up the theory of our previous course, of our special course of asset valuation. As I said earlier, certainly in our DCF approach, P&L report will be very useful. And certainly based on our P&L approach, we'll find our sales, we'll find the growth of our sales, we'll find the weight of all our expenditures in our sales, we'll find the average meaning of our depreciation, and based on our depreciation, we'll find perhaps our capital expenditures. If we have no information how to forecast our capital expenditures, we'll make the equivalence between our capital expenditures and our depreciation. But in which context will we use the information from our balance sheet? In DCF approach, in our income approach? You can use the microphone or you can use the chat as you want. You can write your answers in chat. I now repeat the question. In our DCF approach, we'll use our financial statement results, we'll use our P&L results, and certainly we'll construct our DCF approach based on information of our P&L. But how could we use our balance sheet? How could we use the information from our balance sheet in DCF approach? The main part of DCF approach certainly will be constructed based on our P&L. But how could we use the balance sheet in our DCF approach? How could we use? Perhaps which corrections should we add in the end of our DCF approach to find the true value of our business, to find the real value of our business? How do you think? Could we expect that P&L will be enough to realize the DCF approach? How do you think? How could we use the results of our balance sheet in finding the company value based on DCF approach? How do you think? Tatiana, Anastasia, how do you think? Alexandra, how do you think about the using balance sheet in finding the company value in the context of DCF? How do you think? Certainly, we'll find all parameters based on our P&L, but how could we use our balance sheet in DCF approach? What are your proposals of using balance sheet? Or which corrections will we add in the end of our DCF approach? How do you think? Ekaterina, perhaps Dinara, Polina. Can you hear me? To tell the truth, after forecasting, P&L is not enough because there is no information about assets and depreciation, so on. Ekaterina, thanks a lot for HMM. Maria, thanks a lot for your freelance. Thanks a lot. Exactly. In our P&L, using our P&L, we'll find our, it's an interesting question, exactly. In our P&L, certainly we'll find the growth of our sales. We can find the weight of all our positions in sales. But our depreciation, exactly, we can take from our balance of the company, from the explanation for the balance of our company. It's more about expenditures. Exactly. Thanks a lot, Mo. Thanks a lot for your answer. And as about depreciation, we'll take the meaning of our depreciation from the balance sheet. As about financial assets, they can be included in our cash flows of the company on the one hand, but perhaps on the other hand, our company possesses financial assets and they are not attracted in turnover in our company, in production and in financial turnover in your business. And so why, as the last correction, after finding the sum of our cash flows during the explicit forecast period and after the explicit forecast period, we'll find the fair value of your business by adding different financial assets of your business. In other words, it will be the previous point of view for business plus financial assets of our business plus financial securities, for example, of our business. Thanks a lot for your participation. And certainly, spreading historical financial statements and we'll use all changes for our business, common sizing normalized historical financial statements, and we'll use these results in different approaches, and subjecting normalized historical financial statements to industry comparison. In other words, we'll exclude the outlines in these parameters, our outlines such as maximum, minimum expenditures, and our incomes received only in one times in our financial statement. Good. And finishing this theoretical first part, theoretical framework, and then we'll start different approach, then summarizing different approach in company's valuation. I'd like to divide two categories in our company valuation, such as value and such as the price for our business. On the one hand, we can make the equivalence or we can make our value equal to our price. But if we are escaping the theoretical frameworks, if we are leaving or abandoning our theoretical framework and start the practical framework for our business, there are a lot of differences between our value and our price. As about our value must be associated with the theoretical framework, must be associated with the true value of our business, or the real value of our business based on cash flows. In other words, our company equals the sum of all expected cash flows for this business, of all expected free cash flows for our business. Perhaps based on our per comparison method, our value reflects the attitude between our company and different market participants. In other words, if the value of market traded company equals 8 multiply of net income or 8 multiply on net operation profit after taxes, our company has the following value. It will be 8 multiply on achieved financial results of your business, of your company. And it will be the expected value of your business. It will be the true value of your company. Perhaps it will be the fair value, the correct value of your company. But as about the price, our price is the reflection of investors' attitude for our business, is the reflection of investors' expectations for our business. And in this context, it will be the amount of cash, we have some cash equivalents, for which our investors are ready to sell or to buy the business, to sell or to buy the assets. So while our price is the reflection or the reflection of our market expectations, and our value is the reflection of our financial results, of achieved financial results in form of our real assets or in form of our cash flows. The main purposes of comparative analysis between our value and our price are the following. In company buying and selling operations, for the buyer, the valuation will tell him the highest price he should pay. And for our seller, the valuation pursued and the company value reflects the lowest price at which he should sell the business. And valuations of listed companies are used to compare the value achieved by the turnover of our shares in the market, on the stock market, with our real possibilities of the business, and to decide whether to sell, buy, or perhaps to post a flat position, to occupy a flat position and to hold the shares. In operations of public offerings, the valuation is used to justify the price at which the shares are offered to the public. And in other words, it will be the start point in our initial purpose offering. Perhaps we can use a comparative analysis between our valuation and our value and our price. In the case of inheritance and wills, the valuation is used to compare the shares value with that of the other assets. Our true value of the company will be useful in different compensation schemes based on value creation, And certainly our topic of administrative options. So I have forgotten the word. Our administrative options will be concentrated on the real value of our business, or our managers try to boost the fair value of our business, the true value of our business, to realize the administrative options with the profit. The valuation of a company or business unit is fundamental for quantifying the value creation attributable to the executives being assessed. And certainly for our managers, as we named our managers as the stakeholders for our business, our value will propose to identify the value drivers to boost the company value. The valuation of a company is for stratifying the main value drivers. Certainly, our comparative analysis between value and our price will be useful for making strategic decisions on the company's continued existence. Perhaps it's necessary to modify our business. Perhaps it's necessary to transform our business. Perhaps it's necessary to realize the decision to milk, to grow, to buy other companies, to grow our business, to continue our business, or to abandon, to leave our business. And certainly for our managers, our value plays a very high role in strategic planning about future operations and future actions of your business. The valuation of the company and the different business units is fundamental for deciding what products, business lines, countries, customers to maintain, grow, and to abandon. And certainly it's quite necessary to determine the standards of our value. And on this slide, I proposed the main variants, the main kinds of our value. And today I repeated many times our fair value. In other words, our real value are produced by cash flows of our company or realized by the results of our comparative approach for comparison method. Our fair value, or we can name this category as a real value of our business. Secondly, our market value. Our market value, it's real value, but in the market, based on expectations, based on attitudes, based on future directions of our business for investors, first of all. Certainly our investment value and our intrinsic value or our internal value of the business. Sometimes we can compare our fair value and intrinsic value of our business, and as about fair value, it's a real value. As about our intrinsic value, it's a real value proposed, first of all, by the assets of our company, by the assets of our business. Liquidation value, it means the value after the following actions, such as destroy the business, to destroy the business or to liquidate the business. And we can divide our liquidation value into two variants, as orderly and forced liquidation. In the situation of orderly liquidation, we have enough time to sell the assets, to realize the assets on the best market conditions. In other words, so we have the opportunity, we have the period of time to find a good buyer for our business, to find a good acquirer for our business, and perhaps to start a good deal of mergers and acquisition. In the situation of forced liquidation and especially the situation of forced liquidation we can find in the situation of the bankruptcy or financial default of our company. In this context, we have no time to find a good purchaser, a good buyer of your business. And so why you have a very short period of time to realize all assets on the one hand, and you have a very short period of time to receive cash and cash equivalents. And especially in situation of the bankruptcy or financial default, certainly you realize all liquid assets very quickly and you return all your obligations, all your debts to stakeholders. And as about our capitalization can be founded in the following way: by multiplying the amount of shares outstanding plus our by the amount of our shares outstanding, multiplying their market value, and plus perhaps the growth of our company, such as positive changes in our market value. And in other words, the classical mechanism of our capitalization will be amount of shares outstanding multiply the market value. And perhaps you can correct the capitalization by the future growth. And to tell the truth, I have two questions. As you can notice, I missed the explanation of two parameters, such as investment value and such as differences between our market value and capitalization. And I'd like to return in our chat and propose the following question for us. The following question will be: how could you explain the investment value? What does it mean, the investment value? Or how could you characterize the investment value of our business? Could you make the explanation of investment value? Investment value is a value perceived by certain investors. Exactly. Could you continue your explanation, perhaps using the microphone? I think it will be the best variant. How he estimate property? I can agree with you, but partly. I can't totally agree with the word, with the category property. Could you continue your thought? For example, if our investor associates the business with the property, certainly, it will be the mechanism, the best way of using the property. And it will be our investment value equals or means how our investor estimates property. But if our investor associates the business with expected cash flows, it will be the estimation of financial results. Expected cash flows of our business, good. And another variance of explanation of our investment value. Perhaps another explanations of our investment value. Could we expect the different meanings of investment value? Or it will be the same amount, the same meaning for all investors? Could we approve or could we expect our investment value the same for all investors? or perhaps our investment value depends on, I don't know, different categories. I don't like to name this categories certainly. Estimation of future potential, I mean, highly subjective estimation. Good. Thanks a lot for your explanation, for additional information. Victor, thanks a lot. Exactly. Our investment value reflects the expectations of different investors, and certainly our investment value will be different for all investors. Perhaps one investor, let's suppose the following situation. One investor values the fixed assets of our business, and he's not interested in cash flows and perspectives and future possibilities of our business. Our investor will buy only the assets of this business, only the equipment or only the plant of this business, only the technology of this business, only the research and developing of this business, certainly. And it will be, thanks a lot, Marina. Just a second, certainly I've returned for your answer. Our investor estimates only the property. And so why certainly the investment value for this investor will be formed by the value of assets. Another investor is trying to realize M&A deal, mergers and acquisition deal, and in this context, our investor estimates possible cash flows and possible synergetic effect and synergy in this deal. And so why it will be the accent of for cash flows of this business. And in comparative approach, perhaps our investor is interested in receiving a strong, stable participant of market. And so why it will be the comparative analysis for different analysts. And so why our investment value will be different for all investors according to their expectations and their purposes of acquiring the business. Value of the property, market value in future to investor. Exactly, value of the property in the form of cash flows or in the form of our property, of our assets. Good. Thanks a lot for your explanations, for your additional information. And the second question is the following. Could you compare the market value and the capitalization? Could we name our market value as the capitalization? Or could we make the equivalence between our market value of business and our capitalization? How do you think? Perhaps you can write, I don't know, the formula of the market value, or perhaps you can say the equivalence between the capitalization and the market value. Could we name our market value the same as the capitalization? How do you think? Is our market value the same value as our capitalization? How do you think? Perhaps it's quite necessary to compare our capitalization with our enterprise value, first of all. Capitalization could overestimate or underestimate our business. It depends on overall market situation. Good, as a short explanation. Victor, thanks a lot. Another explanation. Is the capitalization the same category as the market value? Or perhaps our market value could be presented in another point of view? How do you think? our market value. Market value equals, while market value is a theoretical framework how to estimate the company. Good. I can agree with this answer, but if we are finding the short definition of our market value, and so I propose you to compare enterprise value of the business and the capitalization, to tell the truth, and if we are proposing they are different in their calculation precision. Anastasia, thanks a lot for your participation. And to tell the truth, if we have received the task to propose the formula of our market value, it will be our capitalization. Just a second, I'm typing. Capitalization plus our long-term debt, market value, long-term debt, plus our short-term debt in the forms of our trade payables and short credits, and minus our cash, In other words, our market value of the business. In most cases, certainly our market value in a global point of view, in a global explanation, can be associated with the capitalization. But if we are naming the category market value of the company is, you should make the accents for capitalization and for the debt. In other words, our capitalization, certainly our shares outstanding, the amount of shares outstanding multiplied their market value. And sometimes, if we have to find the total market value of our business, I'm reading the answer of Marina, so I made a pause. And if we are finding total market value of our business, we can say it will be our capitalization plus our net debt of the business. And market value is a branch of estimation, while capitalization number of shares. Good. Thanks a lot for your participation. Thanks a lot for your answers. Exactly, in most cases, certainly we can make the equivalence between our market value and our capitalization. But if we are continuing the theoretical framework, market value can include the net debt, the market value of net debt of our company. And finishing this first lecture on our asset valuation, company valuation, I'd like to propose a short report about different companies and different, first of all, different approaches in company value. And find the connection between the financial results and our assets. You can find the highest value of our book value of assets. And to tell the truth, if our company has an international financial standard presentation of financial statements, according to the requirements of our IFRS, all assets must be revalued each year or each quarter, but in common cases each year, all our assets must be revalued annually. And so why you can find the companies, the first 14 companies with a higher value of assets, and all these companies certainly prepare the financial statements based on FRS, so using FRS, and so why you can find in the last column the market value of their assets, and you can find the highest value of assets for companies such as Agricultural Bank of China, and CBS, the same China company, and different companies such as JP Morgan Chase, Berkshire Hathaway. It's a well-known financial investment fund, and Saudi Arabic oil company, Saudi Aramco. The value of assets, but on this case, you can only compare the sales of these companies, profits after excluding all expenditures, and the book value of their assets. And certainly our China, United States, and Saudi Arabia, sometimes Japan, will be included in this list of companies with a high value of assets and good financial results. And in this case, I can say best financial results. And now let's compare this variance of company, this list of companies with market capitalization, with the market capitalization, market value in global point of view of this business. And you can find the letters in this ranking of the companies in market capitalization. You can find the letters of the last report on companies valuation. Saudi Arabian Oil Company, Saudi Aramco, Saudi Arabia, has the highest level of market capitalization. Then certainly our Microsoft company. The third position is occupied by Apple company and Amazon, Amazon.com. Our Alphabet company, Facebook, Alibaba, well-known internet company of China, Berkshire Hathaway investment fund, as I explained to you earlier, Johnson & Johnson, and the last position in this rank of well-known and very high level of capitalization company on this slide is occupied by Nestle company, Walmart United States company, and Nestle Switzerland company. Good. Now, according to our schedule, we have the rest, and after 30 minutes, we'll continue our lecture. Now, let's have a rest. In 30 minutes, we'll restart our lecture.